Welcome to the Diary of an Apartment Investor podcast. I'm your host, Brian Briscoe with Streamline Capital. Very excited today. We've got Jay Balekar on the line with us today. So, Jay, how's it going?
It's going great, Brian. Now that I'm talking to you, it's going even better. So thanks for having me.
Awesome. Hey, thanks for that. And I echo the sentiment. So, well, do us a favor. Tell us a little bit about yourself and, kind of how you got into real estate.
Yeah, absolutely. Thanks, Brian. I'm Jay. I'm based in Cincinnati, Ohio. I've been here for almost 15 years now. And in my past life, I
Mhm.
was working for Deloitte, got a background in computer engineering. I
Mhm.
was doing cybersecurity consulting work. I did that for exactly 10 years, 2013 through 23. And while I was doing that, it was a travel job. So I was traveling quite a bit for my work. And
Mhm.
I was reading investing books,
Mhm.
primarily real estate. My dad has been a real estate investor back in India, where I'm originally from, and it has served him well. He has retired off of his cash flow. And I was like,
Nice.
if it can work in India, it has to work in the capitalistic country of the United States, right? So
Yeah.
I picked up Robert Kiyosaki's Rich Dad, Poor Dad. I had read it back in high
Mhm.
school and had loved it back then. And now I had a little chunk of change to invest. I was like, might as well read that book again and
Mhm.
get some inspiration.
Yeah.
And then read Cash Flow Quadrant, a lot of other
Yeah.
multifamily investing books, Bigger Pockets, and Ken McElroy's books. And I was like, okay, this makes a ton of sense.
Mhm.
And in my job, I was basically running on a treadmill. As long as I was working, I was getting a paycheck, but I was
Mhm.
not really building assets. And that really clicked for me. And I was like, okay, I got to make a change here and
Mhm.
start investing in assets that cash flow.
Yeah.
So that's how it really got started. And because I had a travel job, I was a little bit overwhelmed at how am I going to
Mhm.
manage this while I'm traveling. But I started in late 2019, early
Okay.
2020, and that's when COVID happened. So
Yeah.
when I'd bought my first multifamily property, it was 8 units here in Cincinnati that was severely distressed, but in a good location, and it needed a lot of work. And I was like, okay, how am I going to do all this work
Mhm.
when I'm traveling? But then my travel stopped and I
Yeah.
was managing the construction. It was all new to me, lots of
Yeah.
learning through that process. But that's really how I got started in real
Yeah.
estate. So,
Yeah, I started at the same time. We bought our first property in 2019, actually first three
cool.
properties in 2019. I traveled a lot prior to COVID. I made offers on properties from, a couple different countries, but long story short, when COVID shut everything down, that's when this podcast launched. That's when I found time to add one more thing to my plate. It's like, well, I'm
Awesome.
physically going to work 3 days a week now. I'm like, I got plenty extra time, but
Yep.
yeah, COVID was kind of a mixed bag for a lot of people, but glad you were able to get into it and start and put more time into it. So how did everything progress from there?
So the journey was quite exciting since then on. And
Hmm.
during COVID, as you mentioned, there were a lot of uncertainties, but I think the market did okay. I think, of course, a lot of the funding that came from the government also helped in keeping the economy afloat. But we saw the rents going up and the properties performing really well. We only
Hmm.
invest in A and B neighborhoods. So we
Hmm.
didn't have a delinquency issue or evictions issue. So the
Yeah.
properties were performing. And that first deal that I did, in about 8 months, we renovated everything inside and out. It
Hmm.
was a full gut job, new electrical work, plumbing, everything. And then I got the rents from 500 to
Hmm.
about 1100 and got really good quality
Wow.
tenants. And I still self managed that property. And from a management standpoint, it was not a nightmare, which
Mhm.
I'd heard managing
Yeah.
properties is pretty cumbersome, which it is. I mean, it is a lot of
Hmm.
work, but it was fairly smooth sailing. And then we
Hmm.
did a cash out refi and pulled everything that we had invested in the property back out. So it was a infinite return deal, did two cash out refis, and then reinvested that in another 10 unit, another 8 unit, another
Hmm.
12 units. So recycling the capital, got to about 40 units of our own portfolio
Hmm.
using just our capital, me and my wife.
Hmm.
My wife also helps me with leasing side of things and some sort of property management. So, but then we came to a point by 2021, we realized that, okay, we can't buy larger deals and we can't buy enough of them if our capital is always tied up. So
Yeah.
that's when I was already seeing a lot of people doing partnership deals in
Hmm.
syndication structure or JVs on bigger pockets and some of the mastermind groups that I joined. I was like, okay, this is the next step. And I
Hmm.
didn't want to do my first deal in a partnership because I wanted to have a proven track record of at least five
Yeah.
deals. And now that we had taken five deals through full cycle up to a cash out refi, I started reaching out to my network to do joint venture deals.
Hmm.
And then we did about another 12 to 15 deals in the JV structure. And they
Yeah.
were all mid-sized deals
Hmm.
in 20 to 60 unit size range in and around Cincinnati area. So that's kind of what the next step looked like. And
Hmm.
then 2023 onwards, I started syndicating. And then we've done maybe about 7 or 8 syndications as well. And all of this stuff is local to Cincinnati market. So
Okay. Nice. I like the progression there. I think, for people listening and just for conversation's sake, I think if you have the wherewithal to do that, to get a couple under your belt by yourself, that's probably the most responsible way to go. Because, I mean, just bringing in investor money is kind of a big deal. It's,
great.
you want to be a good steward of that money. So, yeah, I love how you did that. You started out, a couple properties on your own, 40 units, JVs, and then into syndications. I think that's probably the best way if you're able to do it. So, when doing deals with your own money versus bringing in partners, what was like the biggest change between how you approach things and how you operate?
That's a great question, Brian. I think the biggest change for me was the weight on my shoulders. I
Hmm.
started to feel that when I
Yeah.
had money from friends and family involved in the deals,
Hmm.
and also a lot more communication. So, asset management calls with investors, investor communication calls, and monthly updates. So, making sure that they stay up to date on everything that we are doing.
Yeah.
And when you buy right, manage right, and finance right, most things do go right, but there's
Mhm.
always something that goes wrong.
Yeah.
And I think my goal always has been, if something does not go according to the plan, I
Hmm.
let the investors know right away exactly what's happening and what's our plan of action.
Yes.
So definitely that was the biggest change for me. It was
Mhm.
investor communication and just that added level of accountability in terms of managing
Yeah.
investor capital.
Yeah, that's true. I've got a couple of properties where, we did smaller 3, 4 partners, where between the four of us, we put all the money in. And I think you make a really good point. There's a different level of stress, I guess. You
Yes.
want to perform for other investors. My own property, if I don't get my taxes done soon enough, I don't care. It's just like, but the reason I bring taxes up right now is, we're waiting on CPAs to get K1s out, and
Mhm.
I'm getting pinged about that every day. But yeah, I agree with what you're saying is there's a much more of a pressure to perform, when you bring other people's money in.
Absolutely.
Yeah. So going into syndications now, what was the biggest change in how you had to approach things, once you were syndicating?
Absolutely. I think in terms of just approaching the deals and what we are pursuing with the
Hmm.
syndication model, because a lot of the investors who are true LPs or passive investors are
Hmm.
newer investors. This potentially is the first investment that they have done outside of the stock market, right?
Hmm.
So, although it's really my responsibility to educate them to a certain extent, whenever surprises do arise, they get alarmed very quickly. So I think we have to be extra cautious and careful and conservative when we are looking at deals. Higher emphasis on reserves on all the properties. So we keep about 6 months of principal, interest,
Hmm.
taxes, and insurance in reserves,
Yep.
plus some more capex and operational reserves on the property.
Hmm.
But even after doing all of that, no matter how good you are doing as an operator,
Hmm.
you're still exposed to market forces. So we
Yeah.
had one deal where we had to stop distributions because of the market forces, right? Slightly
Yeah.
higher vacancy, taxes, insurance going up. And my phone starts to ring immediately, right? But taking the time to educate the investors exactly what's happening and what's the
Hmm.
course of action. Because sometimes what happens is if it's your own deal and if you have faith in the asset and the market, you'd be okay with not drawing cash for 6 months
Right.
to a year, as long as you have faith in the asset and the market.
Hmm.
But communicating that you have the faith in the asset and market effectively to investors becomes a key role at that point. And that's where I think you have to be very cautious with syndications, because a lot of people started syndicating multifamily in the last 5 to 8 years.
Yeah.
And really, up until 2023 was kind of the bull run, a decade long bull run for
Mhm.
multifamily. And it's kind of slowed down right now. So I think managing expectations with investors is crucial, and
Mhm.
underwriting for cash flow day one, because that's kind of what people want. and certain minimum metrics like a
Yeah.
15 to 16 IRR. Because if I'm buying a deal in a class A location where I know that
Mhm.
long term this would be a phenomenal property, but it's giving me a 12 IRR, that's probably not something that I could syndicate and raise capital for, right?
Yeah.
So those are kind of the differences. So I
Yeah.
look at a property from both lenses that, okay, is this a ripe deal for JV where I can just have a handful of people who share my vision and are
Mhm.
willing to take the same risks that I am willing to take? Or is this a property ripe for syndication and something larger that would cash flow day one, for example?
Yeah, yeah, absolutely. Whole new level. Now, a couple things you mentioned I want to kind of highlight.
Mhm.
This is something I've been thinking about a lot lately. Scrolling through social media, and somehow I saw a bunch of investor complaining about specific sponsors and kind of went down that rabbit hole. What I've been thinking about is how much of what's happened in the last couple of years was due to sponsors versus how much was due to market, and I think it's hard for sponsors to operate, and hit the returns they want if prices
Right.
go down 20, 30%. But maybe your thoughts on that, what risk is for investors is in the market and what risk for investors is in the sponsorship and how to navigate that as an
Right.
investor.
Yeah, I mean, that's a great question, Brian. And
Mhm.
whenever I talk to my investors, I usually share my thoughts on this because I
Mhm.
feel like when something does not go according to the plan, there's always two sides to the story. And I do believe that it's got a good extent of this is
Mhm.
to do with the market.
Yep.
But to some extent, it's also sponsors, right? Because there's been too many new sponsors who tried to go after larger deals. And it was the first deal they were doing was a 200 unit multi-million-dollar property. And if you don't have the experience or the right mentors behind your back or co-GPs who are experienced, that
Yeah.
can be a big risk. At this point, you're playing with other people's money, which is
Mhm.
very risky. And I've seen that, and I've seen deals go south with those types of inexperienced sponsors.
Mhm.
So in that case, I would definitely say that to some extent, some of the
Mhm.
sponsors were a little reckless. But at the same time, I'm seeing some sponsors whose deals, I would say they are struggling in terms of they have stopped distributions, or
Mhm.
in some cases, they have capital calls, but they haven't foreclosed on. And I know some of these sponsors who are phenomenal operators.
Mhm.
They've got the best intentions in their mind. They want to
Mhm.
protect their investor capital, but it's just that so many things have gone against their plans in terms of market that there's so little that they can do to save this scenario. Like I said, insurance prices doubling, quadrupling in certain markets, taxes
Mhm.
going up, cost of capital going up. And if it was on floating interest bridge debt, which was really the only tool you could use on
Mhm.
many of these properties, if they're large enough properties that are not stabilized, that was the only tool you could use. And
Mhm.
now their mortgage payments have doubled. So
Yep.
it's been a constant attack on these sponsors, and now they have to deal with it. So I would say that definitely a good chunk of it, I would say
Mhm.
60% of it, is market forces.
Yeah.
And as we all know, market runs in cycles. So as long as I
Mhm.
would say that these sponsors work really hard to just hold on to that asset, you're
Yeah.
going to come out of this on the other side okay, right? When the market recovers.
Yeah.
So I do think it's definitely both sides, which is whenever someone asks me what to look at when investing passively, I
Mhm.
really think it's really not only about the deal and the numbers presented to you. It's
Yeah.
really about the sponsor, their integrity, their track record. That's the number one thing that I would look at. I've invested passively with a few sponsors, and I probably looked at the deal in terms of the numbers for about 10%, but
Mhm.
90% of the weight was given to who I'm investing with, what is their track record, and do I actually know if this person is trustworthy and how is the integrity for that individual. So
Yeah, I love that. One of my partners in several of our deals has said something very similar to your closing line on there. He basically has said, "I'm okay and I understand market risk, and if I lose money, because the market tanks, I'm okay with that." But he followed up by saying, he's like, what I have zero tolerance for is people without integrity, sponsors without integrity. I always remember him saying that. It was like 2 years ago he said that to me, but I
Mhm.
always remember that because I think that resonates with a lot of people. I
Absolutely.
lost 100,000 in a deal that I invested passively in last year. And, when I did an analysis of it, looking up and down, I would say it was probably 80%, 90% market forces. The operators weren't perfect and no operators are, but, I looked at the facts and it's like, even if they would have operated it perfectly, we probably still would have lost money,
Right.
just because of where the market went. But yeah, I
Yes.
think there's risks to both sides. And, one thing that I've been thinking about a lot lately is helping people understand the difference. maybe, but
Yep.
maybe that'll be a good
Absolutely.
LinkedIn post coming up here soon. But so let's talk about, I mean, your current portfolio. You mentioned that you're within a short distance. Everything's within a short distance of Cincinnati. You've got a mixture of, cell phone properties, syndicated properties, JVs. I don't know if you mentioned this since we hit the record button, but I know prior to recording, you mentioned that you do all of the management on it, and you also are running all the construction crews as well. Can you talk a little bit about your management philosophy, like why you chose to do it that way, and how it's going?
Yeah, absolutely. So initially, when the portfolio was small and I was just managing my own properties, I've always done construction in-house
Hmm.
because I do think that I've tried to work with companies that do provide construction management,
Hmm.
but the margins on that were so large that I was paying a lot more money than it would actually cost me if I
Hmm.
oversaw construction myself. And then the
Yeah.
portfolio was small enough where I couldn't hire a construction manager, right? So I always started that way. I vetted a few contractors.
Hmm.
After I started to work with those contractors, it started to get easier. And
Hmm.
then the smaller portfolio that I had, about 40 units, I was just personally managing it with my wife.
Yeah.
But then after we started doing JVs, we actually started using third party management companies.
Okay.
And some were great, many not so much.
Hmm.
And even after we were transitioning from one management company to the other, the next one, there would be something else with that company. And while you transition, it's the property that takes a toll
Yeah.
and does the investors. So now we are three partners, me
Hmm.
and my partner DJ, who's also local, and
Hmm.
then Andy Crawford, he's also local to Cincinnati. So
Yeah.
DJ actually runs our property management vertical and the
Hmm.
operations. Other partner, Andy, is kind of the investor relations and capital raising person.
Hmm.
And then I do a lot of asset management. I'm still plugged into construction,
Hmm.
and then I focus on acquisitions as well.
Nice.
And
Nice.
I think splitting those roles and responsibilities is helpful because now everything is not on one of the partners.
Hmm.
And because my partner DJ had already built a good property management company with
Hmm.
really good documented processes and KPIs and a great team, it made sense to bring the entire portfolio in house and
Hmm.
starting to run that internally under one roof. And
Yeah.
what we realized was with third party management, we were anywhere between 50 and 55% expense ratio. And
Hmm.
now bringing it in house, we are down to 41 to 42% expense ratio. So now that the margins are thinning in multifamily because of all the forces that we spoke about,
Yeah.
I think we are trying to see, okay, where can we actually cut our expenses? And
Hmm.
this 10 to 14% in OPEX reduction was absolutely huge and helped the valuation of the property and NOI and stuff like that.
Yeah. Yeah,
So,
and that's something, third-party property managers, I've said this many times, I kind of have a love-hate relationship with them. I love them because I don't want to do the work myself, but at the same time, I don't think I've ever found one that I've been truly happy with, And it's a constant, it seems like a constant fight, to get them to manage a property like you want it managed. So you mentioned the benefits was being able to control costs. What's the downside to bringing in management, and how many units are you guys managing?
we are managing around 550 units in this area,
Mhm.
spread across almost 20 transactions. So you can see that our deal
Yeah.
size is kind of small. Like I
Hmm.
said, about 20 through 70 units in that size range. So I would say with a scattered portfolio like that, leveraging a good third party manager becomes even more difficult
Hmm.
because some of the larger property managers, they want to only work with institutional grade assets,
Yeah.
anything 150 units and up, class A. So we
Hmm.
do have a couple of those options in our market, but our assets don't meet that criteria.
Hmm.
And a lot of the mid-sized to smaller property managers were very ad hoc. They didn't have the processes laid out. The
Yep.
communication was not quite there. And, I'm not really trying to badmouth third-party managers, but if you're making about 8 to 10% of revenue,
Mhm.
the margins are kind of tight. And
Yeah.
then if I had no equity in that deal, as a third party manager, just kind of wearing their shoes here for a minute, instead of getting, let's say, $1,000 in rent for one apartment, if I can get the lease signed today for 900, I'm anyways only getting $10 more on
Yeah.
that $100 difference. So I'm incentivized to sign a lease at a lower price today rather than continue
Mhm.
to market the unit at $1,000. And
Mhm.
that's kind of where
Yeah.
sometimes the interests are not completely aligned.
Yeah.
But we were actually willing to give equity in some of our deals if we found the right property manager who we
Yeah.
thought would scale with us. We just
Mhm.
quite didn't get that level of confidence amongst some of the property managers that we worked with. So I would say the downside is definitely it adds quite a bit more work on our side in terms of the day-to-day operations of the property, overseeing maintenance, overseeing leasing, managing vendors and all of that. But I think now we have pretty good systems set up for that. But then the goal now is to look at 50 units and up in our local market, or 100 units and up in Lexington, Kentucky, Indiana, and Columbus. That way we can have full-time management teams on site. And that way we'll have more reliable people that we can trust and rely on, and it will help reduce some of our overhead that we have now.
Yeah, that's something I debate a lot as well is, do I want to bring it in-house? Would I rather? And at this point, we're still using third-party property management, but, I think there's pros and cons both directions. You'll get better management, bring it in-house. I think the biggest thing that is a detractor for me is just the work it takes to leave a third-party property manager and bring it in-house. If that part were easier, I'd probably be doing it myself at this point.
Agreed.
Awesome. So, looking forward, we talked a lot about what's, current operations look like. What's next for you?
Yes. So the plan forward, we do plan on focusing on multifamily and staying in our lane. That's what we've done for now almost 6 years. And we don't see a reason to change that. I do see quite a few people pivoting to other assets or buying businesses and stuff like that. The way we look at it is, and we're also looking at some of the other operators who have been doing this for multiple decades, right? And examples being, like folks like Ken McElroy or Ivan Barrett out of Indianapolis, right? I mean, some of these people have done multifamily for 20 to 30 years. And they have seen the market cycles and they didn't change their path, right? So I think doing what you do best and continuing to focus on it is perhaps the right move. So we have decided just to focus on multifamily. We do want to acquire larger assets, like I said, at least 50 units and up in the local market or 100 units and up elsewhere. And then basically increasing or improving our investor base, because we've been operators at our core. So we have been so busy with operating and managing these properties that the building of the investor base has been ignored a little bit. And now with the change in market, attracting capital has become exponentially more difficult.
Yes.
So that's been one of our major focus areas as well, in terms of how do we educate our investors and reach out to more people and show them how we can add value.
Yeah. Awesome. So more of the same, just doing it better.
Correct.
Essentially, yeah, awesome. All right, so wrapping up here, next question, and this is my favorite one. So don't screw this one up. I mean, I don't think you will. But if you had to give advice to a brand new investor starting out, getting into the syndication space, what would that advice be?
Yeah, no, that's a great question. And I would say I have asked this question when I was starting out to a lot of people, and I got very different responses or a lot of different advice.
Yep.
But I would say that if you're starting on the active side, I do not subscribe to the philosophy of go big or go home. I believe in starting small and learning your lessons, because a lot of people preach that, the amount of effort it takes on a smaller deal versus a larger deal is about the same, which I do agree with. But at the same time, your mistakes are 10 times bigger on a larger deal. So $1,000 mistake could be $100,000 mistake on a larger deal. Yeah. And that's something that people don't really talk about, right? And that's the downside, which is why I really believe in starting small. That way, if you fail a few times, you don't go bankrupt, and you can learn your lessons and do it better the next time. Yeah. Have good mentors, have good teachers, because they will save you from a potential disaster. Invest in education. I invested in education and just focused on education for almost 2 years before I actually pulled trigger on my first deal. So I think that would be kind of my main advice, especially because now we don't have tailwinds from the market. We have major headwinds. So if you make a mistake, the market on top of that is working against you. That one mistake could bury you. In the last few years, we saw that some operators made a few mistakes, but the market helped them recover from those mistakes.
Yeah.
which is no longer the case.
Right.
And then on the passive investing side, something that I already mentioned is do not focus overly on the numbers that are being presented to you, because minor tweaks on the back end on the underwriting, like exit cap rate and rent growth projections, can make huge difference in those returns. So I would say focus really on the operator, getting to know the operator, looking at their track record, and asking the question, is this someone I can trust?
Yeah.
Rather than what do the returns look like, right? So, which has been Warren Buffett's investment philosophy as well. He puts his money on the jockey, and I would advise the same, right? So, I think that would be my advice, whether you're doing active or passive investing.
Yeah. You know, Warren Buffett, one thing, I mean, he said this last year when his longtime partner died. He says their philosophy was to buy good assets at fair prices and hold them long term, you know, and part of that good asset was, you know, betting on the jockey. You know, it's you know, making sure it's well run 100%. So,
Absolutely.
all right, last question. How can listeners learn more about you?
Sure. Yeah, I'm very active on Facebook, LinkedIn. My name is Jaydeep, Jaideep. I go by Jay. Last name is Balekar. And then also, I'll give you the Calendly link. I love to talk to people and set up calls with them to understand their investing goals. So it's calendly.com/Jay Balekar.
Awesome. Awesome. And we'll have that in the show notes. Anybody interested in checking that out, it's all you got to do is go to the show notes and find it. So, Jay, thanks for coming on the show today. Very much appreciate your time, and it was great chatting with you.
Yeah. Thank you so much for having me, Brian. Appreciate it.